Morning, welcome to the end of week Ainsley news. It's been a pretty big week worldwide. Today we're talking the secular bear market. Is this the start, recession or depression? Pretty big topics here. When we talk about bull markets and bear markets, we often get swept up in the present without stepping back and looking at the bigger picture. In this sense, we tend to look at cyclical market trends as opposed to secular, derived from the Latin word for long. The accepted metric for a cyclical bull or bear market is reaching 20% from a recent low or high. Secular bull markets consist of secular trends that lead to new all-time highs, irrespective of intervening cyclical lows or highs. The chart next shown maps out all the secular bull and bear markets since 1871, in inflation-adjusted terms, for the US S&P share market index. It assumes, though it is yet to be proven, that we have begun the next secular bear market from the February of this current year in 2020. All those ones where it starts hitting a bear market are shown in red, bull markets are in blue. Looks like we've just ticked off that in 2020 this year. Probably the clearest, if not controversial, application of this definition is the period started by the Great Depression. As you can see in that previous chart, whilst there was a 266% rally from 1932 to 1937, it did not see a new all-time high before it fell through to 1949. What the chart also showed debunks is what seems to be the current belief, particularly amongst the Robin Hooders, that downturns are short-lived and every dip is to be bought. The authors of the above chart of Advisor Perspectives analysed these secular markets from 1871 to that last March 2009 low with these next results. Secular bull gains totaled 2,075% for an average of 415%. Secular bear losses totaled negative 329% for an average of negative 65%. Secular bull years total 80 years versus 52 years for the bears, a 60-40% ratio. So in other words, bear markets on average account for around 40% of total market time. Now, clearly the 1932 to 1937 period was an opportunity to have made some serious money in a bear market. But from a long-term investment perspective, you were worse off through to the end in 1949. As a side note, their study referenced another basis, secular markets, on the more fundamental PE ratio, and concludes we are still in a bear market that started in 2000, with the rally ending this February being the biggest cyclical bull rally inside a secular bear market. The implications are therefore that the next low will be much lower than the 2000 high. To put all of this into perspective and to look for some indication of where it might end, they then add a regression line, which is a best fit that essentially divides the monthly values so that the total distance of the data points above the line equals the total distance below. This tells us where we are now, historically, i.e. 190% or more than double above the average. Interestingly, that regression line represents an average of just 1.8% annualized growth rate. Such is the power of that 40% bear market in wiping out all those bull market gains. They then add an historical upper and a lower channel based on the all-time champion top of the dot-com tech bubble and the bottom of the all-time low, Great Depression, respectively. This next chart here, S&P Historical Composite, highlighting what we were just talking about. So we're still pretty high there, well above that average line there in red. To spell out the obvious takeaway from the chart in cold hard numbers, amid all the speculation around whether the current recession will be a depression, if we were to revisit the projected levels on the last time this happened, we would be looking at losses of nearly 80% from today's levels. 80%. To put that 1.87 historical annualized return into perspective, and highlight again the implication of such a fall, you would subsequently need to realize a 465% gain from that bottom to get back to where we were before the crash. Notable too is that in that last secular bear market from 2000 to 2009, where shares did fall 59%, i.e. more than halved, gold rose over 240%, so it more than doubled. The question remained, are we at that turning point now? And if so, what does the bottom look like? The jury is out too, as whether we should be talking about 2009 to 2020 as a secular bull or the biggest intra-secular bear market bull rally ever. That it was driven predominantly through unprecedented central bank stimulus while presenting anemic economic growth adds fuel to that theory. If so, we are potentially in for one hell of a plunge for the final bottom. We were struck by a succinct and compelling summary of where Australia sits right now in the recession versus depression question by economist Stephen Koukoulas on Monday, which we'll leave with you now. When the Governor of the Reserve Bank of Australia says that official interest rates are likely to remain near 0% for many years, government tax revenue is undershooting forecasts by $20 billion, and government spending is $50 billion above the forecast of a few months ago, even blind Freddy knows the economy is in huge trouble. It is staggering and utterly dispiriting to see around 25% of the workforce either unemployed, underemployment, or having given up looking for work. Those lucky to have a job are being subjected to pay freezes or pay cuts, and many are on edge fearing their job will be next to go. Having stabilised after an early year slump, stock markets are now look to be in big trouble as COVID-19 spreads around the world and policymakers flounder in their support of the economy. In Australia, house prices are now falling. Not precipitously, but falling nonetheless as demand disappears from the closing of the borders and immigration cascades towards zero. According to Treasury, in the 1930s Great Depression, the unemployment rate peaked at just under 20%. Wages fell, prices fell, and government policymakers erred in keeping economic policy too tight for too long. Does that look a little bit familiar to today? What we're seeing now in 2020 is probably not a recession, it's probably a depression. October could be a disaster. Much has been written about how the JobKeeper program will be scaled back at the end of September and the Job Seeker payment will be cut. The government says it is working on policies to help the transition from these stimulatory measures, but it is obvious the amount of money going into the economy from government measures will be substantially smaller in the December quarter than in the September quarter. And that is just part of the problem. In most states and territories, the end of September will see the no eviction policy end for renters of residential property. The no eviction rule was, alas, a half-baked response to the fact that many could not pay their rent while unemployed or wageless. That landlords who were given a mortgage holiday from their banks would keep their head above water and not have kicked people out. When the no eviction policy ends, it is probable there will be a surge in people being evicted for not paying their rent and landlords potentially being driven to force property sales to get themselves out of their financial difficulties. The human tragedy is obvious. The impact on consumer confidence will be sharp and negative. The economy will also be hit by the ending of the mortgage holiday. That is the decision of the banks to allow borrowers to defer making their monthly payments on their mortgage. While repayments were postponed, debt was being accumulated. When the repayment holiday ends, many borrowers will need to find many thousands of dollars a month to resume their repayment schedule, a task that for some will be impossible given that they will be unemployed, their businesses have closed, and their incomes have dropped. What is an economic depression? In one way, the label of recession or depression doesn't really matter that much. If you can't find work, your business is closed, or you're forced to sell your house, your wage is frozen or cut, interest rates are near zero, and the budget deficit is exploding, it's bad news whatever the label attached to the situation. There is no simple definition of what an economic depression is. Thankfully, they are not all that common, which makes the task of defining one open to debate. Most definitions focus on a large fall in economic output, which is GDP, that there is an extended period before the economy regains lost output, the labour market is chronically high underutilisation, and there is price and wage disinflation or deflation. While the hard data on many of those variables is yet to be collated and published, the information that is available suggests that most of the boxes defining a recession have a tentative tick already. The only point of debate is the duration of the current economic malaise. Will it just be 6 months of economic pain? Will it be 12? Or will we have several years where economic growth waxes and wanes at low level of activity, where the labour market is characterised by high unemployment, underemployment, and a low participation rate, when wages, growth and inflation is extremely weak? Wow, thanks for catching news today. Hopefully it hasn't ruined or upset your weekend. We like to keep you informed. Thank you to Stephen Koukoulas for his input on the news today. And remember, you can always read any of our news articles on ainsleyBullion.com.au or check out our bullion products. And also check out Ainsley Wealth if you haven't already for any of our cryptocurrency products. That's ainsleywealth.com.au. Enjoy your weekend and we'll catch you Monday.